When big news breaks in financial markets, something interesting happens. Charts move quickly, prices react immediately, headlines spread across news channels and social media, and traders everywhere begin forming opinions about what will happen next. But during these moments, something deeper is also happening inside the human mind. Our thinking becomes influenced by cognitive biases. Cognitive biases are mental shortcuts that the brain uses to make decisions quickly. These shortcuts can sometimes be helpful, but during big news events, these biases often become stronger. And when cognitive biases become stronger, traders can make decisions that are not based on objective analysis. They are based on emotion, perception, and psychological patterns. In this video, we are going to talk about something extremely important for traders: cognitive biases amplified by big news. Because when major headlines appear in the market, psychology becomes just as important as strategy. If you stay with me until the end of this video, you will understand how cognitive biases influence trader decisions during major news events, why these biases become stronger when markets become emotional, and how disciplined traders protect themselves from these psychological traps. And if you want to continue strengthening your trading psychology and mental discipline, consider subscribing to Bull Mindset. This channel focuses on the mindset, emotional control, and psychological frameworks that help traders remain calm and consistent in financial markets. Now let us begin with the first concept. What are cognitive biases? Cognitive biases are patterns of thinking that influence how we interpret information. The brain uses these patterns to process complex information quickly, but these shortcuts are not always accurate. Sometimes they lead us to incorrect conclusions. In trading, cognitive biases can affect how we interpret price movements, news events, and market expectations. And during big news events, these biases often become amplified. Why does this happen? Because big news creates emotional reactions. When emotions increase, the brain shifts from careful analysis to faster decision-making. Instead of thinking slowly and logically, the brain begins relying on shortcuts. These shortcuts are cognitive biases. Let us talk about one of the most common biases that appears during big news events: recency bias. Recency bias means that people focus heavily on the most recent information. When a major news event occurs, traders often assume that the latest development will continue influencing the market indefinitely. For example, if negative economic news causes the market to drop sharply, traders may assume the decline will continue for a long time. But markets do not always behave that way. Short-term reactions can exaggerate the impact of news. Professional traders understand this. They analyze the broader context, rather than focusing only on the most recent movement. Now let us talk about confirmation bias. Confirmation bias happens when traders search for information that supports their existing belief. Imagine a trader believes that the market will crash after a major economic announcement. Instead of analyzing both sides of the situation, the trader begins looking only for information that confirms that belief. They read negative headlines. They ignore positive signals. They interpret neutral information as negative. This selective perception reinforces their bias. But markets are complex. One-sided thinking can lead to poor decisions. Professional traders remain open to multiple possibilities. They avoid becoming emotionally attached to a single narrative. Now let us discuss another powerful bias: herd mentality. Humans naturally feel safer when following the crowd. When big news spreads through the market, traders begin watching how others react. If many traders start selling, others follow. If many traders start buying, others follow. This collective behavior can create rapid market movements. Sometimes prices move far beyond what the fundamental situation actually justifies. This is why markets can overshoot during periods of extreme emotion. Professional traders recognize herd behavior. Instead of reacting immediately, they analyze whether the crowd may be overreacting. Another bias that becomes stronger during major news events is availability bias. Availability bias means that people give more importance to information that is easy to remember or frequently repeated. When dramatic headlines dominate the news cycle, those headlines remain in the trader's mind. The trader begins believing that the situation is more significant than it might actually be. For example, repeated headlines about a crisis may create the perception that markets will collapse, but markets often absorb news faster than people expect. Professional traders remain aware of how media repetition can influence perception. Now let us talk about loss aversion. Loss aversion is a psychological principle that explains why losses feel more painful than gains feel rewarding. During major news events, markets can move quickly. Prices may fall suddenly. When traders see losses appearing on their screen, the emotional pressure increases. Loss aversion amplifies fear. Traders begin closing positions impulsively to avoid further losses, but emotional exits often happen at the worst possible moment. Professional traders understand this psychological pattern. They rely on predefined risk management instead of emotional decisions. Now let us move into real trading examples. Imagine a major economic announcement that surprises the market. Prices drop rapidly. News channels begin discussing the potential impact. Social media spreads opinions about a possible market crash. Many traders immediately assume the market will continue falling. Recency bias takes control. Traders focus only on the current drop, but later, the market stabilizes and begins recovering. This situation happens frequently because markets often react strongly to news before adjusting to the full context. Now consider another scenario. A trader strongly believes that a particular geopolitical event will push markets higher. They become emotionally attached to that belief. When news appears, they begin searching for confirmation. They ignore signals that contradict their expectation. Confirmation bias prevents them from seeing the full picture. Eventually, the market moves in the opposite direction. This example shows how powerful psychological biases can be. Professional traders recognize these biases. They train themselves to pause and evaluate information carefully. Now let us talk about mental frameworks that help traders protect themselves from cognitive biases. The first framework is awareness. The simple act of recognizing that cognitive biases exist can reduce their influence. When traders know that the mind tends to jump to conclusions during big news events, they become more cautious. The second framework is slowing down. Big news creates urgency. Traders feel pressure to act immediately, but slowing down can protect decision-making. Professional traders often wait for market reactions to stabilize before taking action. This patience allows them to observe the full picture. The third framework is structured analysis. Instead of reacting to headlines, traders analyze price behavior. They examine market structure. They consider multiple scenarios. This disciplined approach reduces emotional influence. Now let us talk about practical exercises that help traders avoid cognitive biases. One useful exercise is the pause rule. When major news appears, pause before making any trading decision. Ask yourself whether your decision is based on analysis or emotion. This simple pause can prevent impulsive trades. Another exercise is writing down your reasoning before entering a trade. This forces the mind to organize thoughts logically. It also reveals whether the decision is based on objective analysis or psychological bias. Another helpful practice is reviewing past trades. By studying previous decisions during major news events, traders can identify patterns in their behavior. This awareness helps reduce repeated mistakes. If this video is helping you understand how cognitive biases influence trading decisions, consider subscribing to Bull Mindset, because mastering trading psychology requires continuous awareness and discipline. Now let us talk about something very important: humility. Markets are complex systems. No trader can predict every outcome. Big news events often create unpredictable reactions. Professional traders remain humble in the face of uncertainty. They avoid overconfidence. They respect risk. And they remain flexible in their thinking. Let me leave you with a final thought. Big news will always influence financial markets. Headlines will create excitement. Opinions will spread quickly. But the most successful traders do not simply react to news. They observe how the market responds, they manage their emotions, and they protect themselves from cognitive biases. Stay patient, stay disciplined, and remember that the strongest traders are not the ones who react fastest. They are the ones who think most clearly when everyone else is emotional. And if you want to continue strengthening that mindset, subscribe to Bull Mindset. Like and share this knowledge with your friends. I will see you in the next video.